Hello and welcome to yet another instalment of our Nucleus Wealth Insights series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. Sitting across from me, we have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, also the founder of internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. We also have Leith van Onselen, our resident Nucleus Wealth economist, who has spent time with both the federal and Victorian treasuries, along with some time as an analyst with Goldman Sachs. Leith now co-authors the widely read Macro Business financial blog with David Llewellyn-Smith. And finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, of course, please check out our people section at www.nucleuswealth.com.
Yes, so hello and welcome to our next instalment of Nucleus Insights, which we entitled Employment Up and Wages Down, so what gives? This has been in aid of the fact that the Australian labour market reports came out last week and obviously been pretty well picked over, and so this is our take on that as well. I'm joined today with our resident chief economist, Leith van Onselen. Welcome, Leith.
G'day, Tim. Hello, everybody.
And also our head of investments, Damien Klassen. G'day, Damien.
Hi, Tim.
So let's jump into it. I've got a bit of an agenda for today. So we're going to be obviously doing a wrap-up of or a review of the Australian labour market report. We'll then jump into some labour trends in Australia and where we think it's headed. There's also the prospect of a new boom in employment. We do love a good boom at Macro Business at Nucleus Wealth, so fascinated to see what's coming up there. And then, as always, wrapping into our implications for investment and how we view these trends into the portfolios every day at Nucleus Wealth. So with no further ado, we'll jump into our jobs growth. So we've got an annual change in jobs growth graph here. What have we got to say about this one, Leith?
Yeah, look, the Australian Treasurer Scott Morrison has been at pains to tell us all that we've got record jobs growth, and his government's delivered 1,000 jobs a day, etc., etc. And in numbers terms, jobs growth has been very strong. It peaked at about 400,000 strong at the end of the year, end of 2017, and it is falling away now. It is fading. It's fallen down to about 330,000, but that's still quite strong jobs growth. And to put that into perspective, in the mid-2000s, we were doing about the current level of jobs growth, and that was during obviously very, very strong economic conditions running into the GFC. So it certainly has been very strong jobs growth over the past year. Flicking across to look at the actual components, I've got a chart here which just shows the jobs growth by full-time, part-time and total. And in percentage terms, total jobs growth has slowed from about 3.4% at the end of 2017 to 2.8% currently. And this slowing has been caused by a sharp slowdown in full-time jobs growth, which at the end of last year was booming at about 4%, and it's currently tracking about 1.9% annual growth, and that's been falling away fairly strongly, and but it's been partly offset by rising part-time jobs. If we flick across to all the major jurisdictions, or the major states, or all the states rather, it shows that the jobs growth is basically fallen away everywhere, except for in New South Wales, where jobs growth is actually, basically flat. It's unchanged. New South Wales...
unchanged at a relatively high peak.
That's right, yeah, that's right. So New South Wales is unchanged. It's running fastest at 3.7% annual growth, which is very strong. Whereas Tasmania and Western Australia are the two laggards. Their annual jobs growth is running at about 1.3%. But across the board, bar New South Wales, which jobs growth is flat, everywhere is fading, which obviously matches the picture nationally.
Yeah, but having said that, all at relatively strong levels again. Like you wouldn't say any one of those markets is particularly weak.
No, certainly not. No, it's still fairly strong overall. And again, we added 330,000 in the year to May, which is still quite fast. Just that it's slowing from 400,000.
The interesting thing I see there, just as a quick takeaway, the Tasmania sort of presents itself as a bit of a leading indicator. Is that would there be any sort of reasoning behind that? I'll draw your attention to
I wouldn't read anything into that.
No, you wouldn't read. No? Okay.
It's the 400,000 people, maybe.
Yeah, look, it's very small. I think Tassie as a whole maybe is 500, but it's it's certainly not a big driver of anything. And it does depend, obviously, on what's happening in the mainland. Gets a bit of refugees from the mainland go across to Tasmania, and it's I wouldn't read anything into it in particular.
When he's saying refugees, he's talking about
mainland
refugees.
Yes. People like the couple that I bought my house from, who sold it to me for an absolute bomb, made out like bandits, and then went to Tassie to live happily ever after.
Yeah, okay, fair enough. Okay, very good. And just before you said it was Tasmania as a whole, not Tasmania as a whole. Just wanted to clear that up for any Taswegians as well, if that didn't come through clearly. I've
got plenty of family down in Tassie.
Very good. Okay, so a year on year change of monthly hours worked. This is quite interesting. This one we've got obviously WA. Very cyclical.
Yeah, so I've just plotted the 5 mainland states here, just to keep it a little bit less noisy. And what it shows is that total hours worked is trending lower at the national level, which is a bit like jobs growth, but it's still fairly high at 2.6% currently. But there is a lot of dispersion between the states. So New South Wales has got the strongest hours worked, running at 3.9%, whereas WA is the slowest at 1.1%. And then there's a big, pretty much all the mainland states bar New South Wales are below the national average. So New South Wales is really pulling up the national average there.
And putting this into perspective with immigration growth and population growth.
Yeah. So yes. Well, population growth running was running about 1.7%. Sorry, just fell from 1.7% to about 1.63, I think it was. It's still running above population growth. So it's still reasonably strong at 2.6% nationally.
Okay, sure thing. We'll jump across to unemployment, and obviously, as you started off there's been a lot of comment made on falling unemployment. Is this necessarily the case? Do you think?
Yes, certainly unemployment has been falling. It was tracking at near 6% back in 2014, and it has fallen to 5.4%. But this isn't by any means mean that we've got low unemployment. The OECD average is 5.4% as well. So Australia's at 5.4% is bang on the OECD developed country average.
Okay.
But it certainly has been falling. It's been trending lower very slowly. It's still, I'd argue it's still above where it should be. And again, we've got this big dispersion. New South Wales is pulling down the national average. New South Wales unemployment is 4.8%, whereas WA is the highest at 6.2%. And all mainland states bar Victoria, which is just below the national average of 5.4, they're all above the national average. So it's really New South Wales that's pulling down the nation.
Well, and that's the story though. For most of that economic growth over the last few years, it's as you said, it's New South Wales and Victoria that's been driving pretty much most of the economic growth, and so they're the ones with the lowest unemployment, and the rest of the states are all above that.
Yeah, well, Victoria's unemployment's actually been not that great. It's slightly below the national average now, but for several years it's been above the national average. But yeah, New South Wales has been really the dominating driver, more so than Victoria. Victoria's done well on growth because it's been adding the most people, but it's not been picked up, I guess, more in these per capita measures.
Okay, fascinating. And obviously, with the fall in unemployment, you'd expect rising wages, but we can move on to that a little bit later. I'll just put a placeholder on that thought.
Well, yeah, but I think as obviously the title of this is that's what we're sort of exploring today is that the disconnect between, well, if unemployment's falling so much and we've got this great jobs market as espoused by our treasurer, then how come wages are stuck where they are? And I think that's the real dichotomy. So this first part's sort of showing, that the employment is quite strong, but as we move in, we'll sort of dig a little bit more into the reasons why. Okay,
sure thing. So sorry, Leith. Yeah,
and that's a wonderful segue to our next chart.
Absolutely. So we'll move from unemployment to underemployment. Might need to start with the definition of underemployment.
Yeah. So underemployment is basically it's where people are employed but they want more hours.
Okay.
So they're employed, casually, part time, and they want to work full time, for example. And this is actually...
And actually, while you're at it, it's worth the definition of employment is also quite strict in terms of your work. Is it an hour in 2 weeks?
You've got to work an hour. I think it's an hour every fortnight, and you also got to be actively looking for work to be classified as unemployed. So if you want a job, but you're not actively looking for work because you're discouraged, you won't be classified as unemployed. Roy Morgan's got an alternative measure, and their unemployment rate is, I think, last time was about 9%, and that has a different definition whereby if you're unemployed but you're not actively looking for work but you would like work, you're classified as unemployed. So,
I think it's more they ask you, are you unemployed?
Yeah, that's right. Yeah, basically.
It's a more subjective measure.
Yeah, and part of it though comes back to, obviously, if you're on a full-time job but you can pick up a 3-hour shift once a fortnight somewhere, you wouldn't think of yourself as employed, but the ABS obviously would, and with the rising
gig economy
and part-time, more and more part-time roles, I think there is sort of that scope for that. So what we're really trying to get to the bottom of is, how much slack is there in the labour market? Just
a more general question, I guess, going back to the definitions of unemployment. Do you think, obviously these rules have been probably put in place quite a while ago, do you think, given the gig economy, casualisation of labour and all these things, that there's just cause to revisit what an unemployed person is as opposed to someone who's underemployed or employed?
Not really. The definitions are actually internationally agreed upon. So it's an international definition whereby all the major statistical agencies around the world follow a similar definition. I think a bigger, and this is what I tend to do, I don't really, when I analyse labour force statistics, I don't even barely look at the unemployment rate. I'll look at all the other indicators because that's where you get the true picture of what's going on. So you look at things like hours worked. Hours worked is critical, and much better figure. It's even better than jobs growth. And I look at things like labour underutilisation, which is unemployment and underemployment combined, underemployment, all these other measures. So if you look at the broader measures, you can get a very good picture of what's going on. But unfortunately, just like with GDP, aggregate GDP, our media tends to focus on the unemployment rate, which is really the wrong thing. You should be looking at these broader measures to get the true flavour of what's going on.
And partly though, because obviously our politicians would like them to focus on both those measures with GDP growth. So it's all about you bring lots of people in, you report a nice high number, and if they've got the choice of reporting an underemployment rate of whatever 8 or 9% or an unemployment rate of 5 something. No questions as to which ones they're going to choose to talk about.
Yeah, actually, that's a good point. The politicians in times like this tend to focus on jobs growth. They don't even look at the unemployment rate so much because, again, Australia's unemployment rate, 5.4%, is the OECD average. So we're no better, we're no worse than the average developed nation. But you don't get... the media reports the unemployment rate, but the politicians like Scott Morrison have been ignoring that, and they've just been focusing on jobs growth. And that again is another quantity-based measure. So if you're bringing in 240,000 migrants we saw last year, and population's grown at roughly 400,000, we're obviously going to have pretty strong jobs growth,
Mm.
even if it's pretty poor, on a per capita basis, which I'm not saying is at the moment, but the politicians at the moment tend to be focusing on jobs growth because that sounds better.
Mm.
So they sort of pick and choose.
Yep.
Especially as jobs and growth is a slogan of
that's right. I mean,
one party.
And look, it does sound great to say, look, we're creating 1,000 jobs a day. It sounds fantastic, but we're adding more than 1,000 people a day. So it's not as good when you break it down to these sort of more per capita measures, which is the sort of stuff that I always look at. And in fact, when it comes to GDP, labour force, whatever, that's pretty much all I look at. I'm a bit different in that respect. I don't even look at I look at it, but I don't care about the aggregate figures. I care about the per person experience.
Well, that makes sense. When you've got an understanding, you want to see what goes into that number, don't you? And that gives you a better picture.
And I care about living standards.
Yep. Mm. And the flip side is, as a human being, he's talking about what he thinks. From an investment perspective, Leith and I were talking earlier today about this dichotomy of saying more people into the economy gives you a worse lived experience, more congestion, more people competing for the same jobs, keeping wages down and all that type of stuff. But as a company, if you've got a monopoly position or a decent sized oligopoly, then more people means more customers, means more profits.
Yep, juice.
And so from an investment perspective, a lot of this stuff is good for the companies, but it's bad for human beings involved in the economy.
And Damien just hit on a fantastic point there. There's in the press today. This is Thursday. There's all this complaining that CEO pay is going through the roof, or executive pay is going through the roof, whereas private sector workers have been going backwards after inflation. Well, this feeds into that point. If you're feeding in more consumers every year, big business obviously makes more money. CEOs make more money, but it means more competition for workers. They've got to pay more for a house and spend more time in traffic. So it's this kind of privatising the gains and socialising the costs on the broader population.
Sure thing. Okay.
That's quite a long definition for you.
It is. Yeah. Great. No more questions, please. No. While we're on the topic of feeding the masses, we'll jump across into the casualisation of labour force. No?
Let's do the underemployment first.
Yeah. Sorry.
Underemployment. Sorry.
Yeah. Sorry.
Here we go.
So speaking of low wages growth, keep this chart in mind. This is actually key. The Australia's underemployment rate, so again, this is people wanting more work, is stuck at a very high 8.5%, which is almost a record high. Like it's slightly down from 8.7 a couple of quarters ago. And again, it's lowest in New South Wales and Victoria, but again, still very high at 8%. And it's highest in South Australia at 9.6%. Just keep this in the back of your mind when we talk about wages a bit later, because we'll bring up another chart which segues beautifully into that one.
Okay, sure. So, casualisation.
Yeah, so it's been pretty well known that Australia and a lot of developed countries around the world have become more casualised. We've got more part-time jobs, less full-time jobs, more the rise of the gig economy. Mm-hmm. Part of this is natural because we've had a lot of females enter the workforce. Like my wife who works part-time and obviously is a mum. So part of it is natural, but it's also this gig economy effect. And
just to describe this chart, ratio of full-time workers to part-time workers is pretty much a 45-degree line, maybe slightly tapering off at the end, but it started at sort of 5.5% in the 70s and is now down to almost 2%. Sorry, two times. So basically, you had 5.5 full-time workers for every part-time worker, mm-hmm. and now we're down to 2 full-time workers for every part-time worker.
So the full-time job share, the share of workers in full-time jobs back in 40 years ago was 68%. So the year I was born, it was 68% versus 85%. It's 68% currently versus 85% 40 years ago. So 40 years ago, 85% of workers are in full-time jobs. Now it's 68%. So this is that kind of, I've called it the casualisation of the workforce. But it's not just Australia, it's happening right around the world in developed nations.
Yep. Okay, very good. Whilst we're on the topic of casualisation, the average monthly hours worked also pretty significant decline from the mid-90s.
Yeah, this is extension of the previous chart. So I've got a chart here showing the average monthly hours worked, and that's fallen from that's currently at a record low of 139 hours per month versus about 148 to 150 hours per month pre-2000.
And sorry, is this is the hours per actual worker, per person with a job, or is this hours across the entire workforce population?
That's a good question. I can't remember this one actually. Sorry.
On spot?
No, it's my fault. I've got two charts that are very similar. I just can't remember which one I picked.
Yeah.
There's one which is sorry. I think this is the per worker one.
Right.
So it was 139 hours per worker versus 148 to 150 pre-2000 per month.
Yeah.
So sorry, I've got two separate charts that look very similar, and one's economy wide and one's the average wise.
Yeah, so this one, I guess where I'm getting to is this one is affected by unemployment rates.
Yep.
Which is why the blips are in there. Yep.
Sorry, more underemployment rates because it's average hours worked per worker. So if you're not working, you wouldn't be calculated.
Okay, sure. So I guess, and obviously the heading there, we're looking at the trends. It's trending down, even in that last slide as well. There was a bit of a plateau. There's a plateau in this one, sort of around the mid to high 130s monthly hours worked. What are your thoughts? Is this sort of, are we going to find it? Is this a new bottom? Is this the new normal?
I think it's probably the new normal. I'm not sure if it's going to get much worse than this, but then again, I just don't know.
I'd like to add, in a lot of countries, the rate that women are involved in the workforce is it looks like it's reached the end, and possibly even turning back in a few countries in terms of fewer women or more women choosing not to work at certain stages of their lifestyle. And so this period, though, it increased dramatically. So the number of women working in the workforce made a huge difference.
Yep.
And the other thing is the aging of the workforce as well. So we've got sort of that baby boomer cohort going through, and they're all sort of in the latter stages of their career now. And so quite possibly as they're reaching the end of their career, they'll look to try and extend their work from full-time and gradually cut back on the hours before finally retiring.
And my father-in-law is an engineer who's basically doing this exact same thing. He's gone from full-time work to working 20 hours a week.
Yep. Wants
a bit more free time, doesn't want to exit the workforce fully, and I know a lot of other boomers, extended family members, etc., in the same boat. So it's been driven, by the rise of women participating, but also, the potentially population aging.
So do you think with that, obviously there's as you say, the transition period for a baby boomer rolling from full-time work to part-time and then just rolling off the employment sort of spectrum, will that potentially give an opportunity for full-time workers, I guess, at the other end? As the golden handcuffs, so to speak, come off the encrusted sort of baby boomer sort of section. Will that allow? Do you think a full-time? Do you reckon we might get an uptick potentially in full-time work as a pickup from there?
Potentially, it wouldn't be for a while because the boomers will be rolling off for a decade or so to more to come. But also, I mean, this gig economy thing's real. We're seeing it, across the board with the Uber economy and all these other, sort of sham contracting, all this kind of thing going around. So I wouldn't be surprised if the full-time share of employment does remain low pretty much indefinitely. I think this is the future.
Yep.
Also, we've got potentially the rise of automation as well down the track, which everyone seems to be concerned about. And that could also potentially lead to, more substitution from workers towards capital, which I'm not sure what impact that'll have on the ratio of full-time to part-time jobs, but
I guess as an overview, though, it's worth noting that so these charts don't look good in terms of the overall trend, but some of that, I guess, some of that is the underemployment bit we're talking about, where people would like to work for longer periods.
Sure.
Yeah. And some of it is structural in that there are people in the workforce who don't want to be full-time and they're happy to be part-time or for lifestyle reasons. And so,
it's not all bad.
So the trend from that perspective is good.
Yeah.
But the trend from the other side is the bad part of which is, can people who want jobs get the jobs?
Yeah. Okay. And again, the key figure here is the underemployment rate, because the unemployment rate only captures people that want more work. So it wouldn't capture someone like my wife who just wants to work part-time, doesn't want to work full-time.
Yeah, sure.
So, yeah.
Fair enough. Okay, so we'll jump across from trends now into an exciting new boom period that Australia appears to be going into, it's been given the title Botox Boom. You might need to just quickly run through what the Botox Boom means for those that don't follow the blog regularly.
Yeah, look, it's a pity Dave's not here. Dave's like the
Apologies for that. I think we had a break in our internet connection, but anyway, we're back again. So we might just we'll kick off at the top though. So we've got our new boom coin, the Botox Boom, Leith. And what can you tell us about the Botox Boom?
Yeah, so the Botox Boom is one of these phrases devised by wordsmith David Llewellyn-Smith, and what it is, it's basically a boom in economic activity and jobs that's been effectively derived via government policy or government spending, rather than being driven by market forces and the private sector. And I've got a chart here which basically splits up the annual jobs growth in Australia to the year to May, which is the latest available, by industry. And what it shows is that that by far the biggest driver of jobs growth has been the two, I guess, Botox Boom affected areas of healthcare and social assistance, which has been driven by obviously ageing population, government healthcare spending, social security spending, and as well as things like the NDIS, as well as construction, which has been impacted heavily by the federal and state governments' infrastructure spending.
Okay.
And healthcare and social assistance added nearly 60,000 jobs over the past year, whereas construction added about 50,000 jobs, and those have been the two biggest drivers over the past year.
And I guess that stands to reason with the NDIS kicking into top gear, and infrastructure spending obviously being at pretty peak levels.
Oh yeah, absolutely. Yes, and I mean I read a report at some point recently which said that the NDIS is expected to add like 100,000 jobs in the first 2 years. So it's certainly been a big driver of the jobs growth. But this has been going on for more than a year. Which if we plot forward to the next chart, which plots the change in jobs across Australia by industry since the GFC. So since August 2008, so nearly a decade. And again, it's this healthcare and social assistance that's been by far the biggest driver. That's added nearly 600,000 jobs over the past nearly decade.
Wow.
Which is huge. And in fact, 4 out of the 6 biggest job creators are heavily reliant on public spending. So we've got obviously healthcare and social assistance, as I just mentioned, but also the third biggest driver has been education, which has added nearly 210,000 jobs. And then we've got also construction, which has added nearly 200,000 jobs, and then public administration and safety has added 100,000 jobs over the past decade. Again, those are 4 out of the 6 biggest job creators are heavily reliant on taxpayer spending, government spending. Yeah.
And going forward, so we're looking. NDIS has got another 6 months of rollout. Is that about right for this? And then I think it's about another 6. Although I read reports recently that it was running behind in a few areas. So look, it'll probably end up running for another year or so. Yep. And then there are some after effects, I'm pretty sure, on that in terms of as the rollouts happen and people start spending the money and realizing that accessing different services and things like that. There's probably a year and a half at least of good growth just from NDIS, maybe 2 years.
Yeah, absolutely. And look, I've got an autistic son, and we're going through the process. And I've got to say, it's a bureaucratic nightmare. And the amount of middlemen and bureaucrats, etc., you got to deal with, it is certainly creating a lot of jobs. Unfortunately, not a lot of, from our experience at least, a lot of those jobs aren't actually in the right areas. They're just really red tape.
Okay.
So it's, for example, to access all layers of red tape, and these are all people employed to basically administer stuff that we were previously accessing without a hitch. So at least from my experience, a lot of it does seem to be going towards bureaucracy and waste.
Well, I think Leith and I are probably on the same page here in terms of there's certain parts of the economy that are good to privatise, and at a certain stage, though, if the pendulum pushes too far and you start privatising things which are complex and used to be run by sort of a government department where people would sort of entrust, and then you say, let me give you something really complex and I'll give you 23 different choices, and now you can employ somebody to help you make those choices because it's so complex. You haven't ended up in a better place in terms of the net effect for the economy, and I think we both argue that to a certain extent the retail the electricity market's been that way as well. I mean the recent reports coming out is that same idea that yes, you've introduced all this competition, but if all they're doing is competing by spending money on ads and they're all just upping their prices and no one can be bothered to check their bill every 3 or 4 times a year to make sure they're on the cheapest rate, then what actually ends up is complexity overcomes people, and all the fees go up. You can see which is going to do well from an investment perspective from this type of thing.
And just like the NDIS stat I've quoted a few times saying that 96% of the money spent on Medicare actually goes to services. It goes to only about 4% of every dollar of tax raised to pay for Medicare is wasted in bureaucracy, whereas private health insurance, for every dollar of premiums they get from you, only about 85% of it goes towards actual care, and the rest of it's eaten up in middleman bureaucracy and
profit.
That as well. But it's easy to see why. If you've got obviously a single payer public health system, you've got one administrator, whereas if you've got a whole bunch of private ones, each of them have got their own little set of HR, set of advertising, set of etc. And it can actually add to more waste.
And just quickly, or finally, the obviously you mentioned before, so you essentially nothing's changed in your life, and everything's changed on the provisional side, moving from the system you had before and then after. No, in terms of your needs.
No, it's gotten worse for us.
It's gotten worse for us as an outcome.
Actually got worse.
But
got
the
worse
point,
situation.
I guess the point I'm trying to make though is pre-NDIS, things were going along well, and then post-NDIS, it's been a lot harder. And so essentially this NDIS instrument, is it sort of like almost, it feels to me like it's quasi-privatisation in the sense where these middlemen have had to come in and,
let's not overplay though, because obviously I think Leith will agree that there's a lot more money being put into it, and there are a lot more people getting services, and like statistical sample of one is not too bad. It's not working well for everyone, and and I think we both agree on that. We think there's a lot of waste going to happen, and there's going to be a lot of unnecessary jobs and things like that. But the reality is they're spending a lot of money, and there's inevitably for more people a good outcome.
Okay.
And I think it's probably similar to the NBN in terms of, yes, they're spending a lot of money, yes, they're probably wasting a lot and doing a lot of things, but there are still the internet's better than it would have been if they hadn't have done anything on the NBN.
Yeah, sure.
So there's sort of those, there's a step about is this a terrible thing, or is it just us acknowledging that there's waste, and by incorporating more and more private sector into complex monopolistic type public money is that there's a chance that we're actually looking at this is actually going to be a key driver for the Australian economy. Why it's called the Botox Boom is because if the same number of people getting the service over the next couple of years, but lots more people employed, it's good in a way, but we're running to do not very much.
That's been one of the outcomes from this jobs boom.
Okay, sure thing. I think we've got a question here. Okay, so what utility or essential service? I think it's a question around the privatisation that I brought up earlier. Has been privatised. It's actually ended up better. Might need a moment to think about that.
Yeah.
So should we bring up CBA, or is that too soon for that?
What about Telstra?
I think I think from those perspective, there are ones.
They're most efficient when you've just got one of them.
Mm-hmm.
And as soon as you turn that into a private monopoly, you open up opportunities for gouging. And we see this with airports. We see this with with electricity. All these key services. We're going to see at the land titles registry now. The state government. Qantas and TAA, which they used to be. It's fine to prioritise the airlines, but same with a lot of things like that. And look, I'll even argue that Medibank Private was probably a good privatisation because it was here we've got a public. So it compares mining jobs to mining jobs, healthcare jobs to healthcare jobs year to year.
And just putting that into perspective for everyone out there. So, sorry, you said this one was 2.1 and
whereas
inflation came out yesterday.
It was about 2. It was about the same.
2.1.
2.1. So
in real
zero.
terms, zero. Yes.
Yeah, but again, that this is the wage price index. So this isn't actually what people are paid. This is just comparing industry against industry, measuring inflation.
Yep.
So what this chart shows is that obviously we've had the very strong healthcare jobs, but healthcare has also been the strongest, had experienced the strongest wages inflation, growing by 2.7%. And by contrast, mining has been growing a lot slower, and it's actually been dragging the average down.
And sorry, just putting that in perspective again, 0.8% real. So we're not, when you say strongest, you'd probably call it not weak as opposed to strongest.
Yeah, it looks spot on. And also again, this is wages inflation, so it doesn't account for substitution in the labour market. We know since the commodity boom ended, we've had less mining jobs and
$50,000 in a mine, and then the mine in the now is not there anymore, and then all of a sudden a new worker, despite the fact the same guy's taken a 50% pay cut.
Spot on. So because of that, average weekly earnings and the National Accounts does average compensation per employee. Those have actually been growing even weaker than this labour price index, and that's purely because of this substitution effect from high paid into low paid.
Sure. Okay. No problems. Interesting graph we've got up here: Australian wage growth and underutilisation rates from 98 to 2018. So what's that? 20 years?
Yeah, that's right. So this actually goes back to the start of the labour price index, and back in the 1998 is when it started, and this was done by Phil Zeus, economist, buddy of mine, and he. Done here, he's plotted the correlations between the underutilisation rate, which is underemployment and unemployment combined, against wages growth. And what he's actually found is the strongest correlation between wages growth for the strongest predictor for wages growth is actually the underemployment rate. It's way more important than the unemployment rate, which actually has a pretty loose fit. And it's even more important than the underutilisation rate. And I said to you before. I said to the listeners before that keep in mind that Australia's underemployment rate's near all-time highs at 8.5%. Now that would suggest, based on these relationships, these correlations, that Australia's wages growth is going to remain under pressure. It's going to remain very low until we can, until the underemployment rate improves from current position, because it does seem to be the key. It does have the strongest relationship to wages growth, certainly a lot stronger than the unemployment rate. And it's because it suggests that there's so much surplus capacity in the labour market.
Okay, sure thing. All right, fantastic. Just finally, in summary, we've got the question posed. So there's obviously the Australian. We've got the shot up there of the Australian real final demand. Looks to be on the rise.
Yeah.
Do you see that continuing?
Yeah. Look. So what this chart shows is from the National Accounts. It basically shows the key growth drivers for the domestic economy. And it's split up into four things. So split up into household final consumption, which accounts for about 55% of the national economy, dwelling investment, business investment, and public demand. And as you can see, as usual, the key driver is household consumption. But what's actually driven the improvement recently is that business investment has turned positive. So after the mining boom ended, we had a huge slump in mining investment, and now that slump sort of worked its way through, and we're finally into a situation where public demand obviously is the other driver. So I mentioned before that we've got the Botox boom rolling on through. That's still running, has a little bit longer to go. Going forward, that's likely to be a drag on growth. My view, this is purely an educated guess. We don't really know what's going to happen, but that dwelling investment is going to keep falling, so that's going to keep dragging. Public demand, based on the forward indicators, look like it's going to near a peak in the next 18 months or so, as the NDIS rollout finishes, as the NBN construction finishes, as all these other public infrastructure works sort of hit peak and they stop growing. It doesn't mean they won't remain high, but they just won't add to growth every year. Whereas business investment's likely to keep rising slowly. So what's probably going to end up being the driver and determine, with all those three factors sort of offsetting each other, what's likely to determine the future trajectory of both domestic activity and also, I guess, wages growth, etc., and employment will depend on consumption spending, because this is the biggest component, 55%. And our view is that consumption spending is going to come under pressure because of this weak wages growth. It's also because consumers are suffering from high debt, and of course, and most importantly, we've got falling house prices. So generally, when house prices fall, you have like a negative wealth effect, and consumers borrow less and they spend less.
Yep.
And with Sydney's house price is down, it's approaching 5.5% year on year. Melbourne's fallen by about 2.5% this year. With the major markets now falling, it's probably likely to start weighing on consumption, and that should obviously flow on into weaker economic activity and potentially wages growth. So it's one of these how long's a piece of string thing. I'm just sort of we don't know for sure, but I wouldn't be surprised if this period of super strong jobs growth becomes a lot more normal and a lot weaker going forward.
Okay, fair enough. And I guess as we brought up in a previous webinar as well, with the confirmed falling in house prices, you could only confirm everything that's going on in terms of demand when one of Australia's biggest economy drivers starts to slip into neutral and perhaps the reverse.
Falling house price and falling dwelling investment.
But it's worth saying from an investment perspective, when you look and say we've got this. Some people are looking at the situation saying unemployment's getting lower and lower and lower. You know what? Wages growth's been weak, but it's about to bite. Employment's going to hit this stage, and it's all about to turn on next thing we know, we're off to the races. And to a certain extent, we've seen a little bit of that in the US. It's not quite there yet, but maybe wage economy and try and apply the same process to it. We just can't see to record and no inflation and wages growth, and still lots of competition from. We keep bringing new workers in to compete with these low end jobs. We just can't see where the wages growth is going to come from to actually sort of spur the next cycle on. And the question is, do we need a further leg down? And if other things start to happen at the same time, house prices falling or weakness offshore, then it opens up the Australian economy for some more dire circumstances. Which is why we feel as if the RBA is not raising rates anytime soon, and quite possibly is going to go the other way before it is going to have to go the other way before it does start raising rates.
Okay. And there is another fly in the ointment too. One of the reasons why we have had weak wages growth is also because we had falling commodity prices. So we had this massive terms of trade boom, massive commodity price boom, which washed heaps of national income into the economy, and that turned around in 2011, collapsed, and then it rebounded a bit recently. Dave's view is that the commodity prices will be weaker next year, and then that other things equal drag on national income, and then also help drag down company profits, wages growth, etc. So that's just another potential negative headwind in the works.
Just a quick one finally before we jump into the investment implications, but look, originally coming from a construction background, quite heavily unionised, and quite often a knee-jerk reaction for unions, obviously having that bargaining power. Perhaps you might say, perhaps there's something there, but do you see there's a potential for the trade unions and those sort of things to perhaps to try and put some pressure on wage prices?
Probably all be at the margin. Certainly, Labor wants to be a lot stricter on temporary visas, for foreign workers, etc. I mean, that's the rhetoric coming out recently, anyway, and that should have that'll have a marginal positive impact. Other things equal, all those things you just talked about. But at the same time, Labor's also promised to whack negative gearing and capital gains tax. So if they follow through with that, well then that would exacerbate the downside of housing, which will have a negative impact there on consumption and growth, etc. So there's so many factors going on. I'm never that these sorts of things just because it's very easy any major turnaround in wage. But one thing's for sure, the wages boom that's time levels is delusional.
I guess it's just supply and demand. there's demand for it, then that's the way she goes. All right, very good. So we'll jump. There we go to implications for investment.
Yeah, so I've sort of almost ran through those before, just on the interest rate side in terms of the and there's certainly downside risks, and then the question is, do you want to pay up for that type of economy? The Aussie market's sort of trading 10%-ish above the world market at the moment in terms of valuations.
Okay.
It's second, pretty much, in terms of major regions, it's second only to the US, and so we sort of take a step back and look and say, well, just a minute, why do we want to pay so much for the Australian market with such a poor growth outlook? Whereas there seems to be a lot better value elsewhere, and where you are paying more for companies, say in the US, you can actually see the growth, and they're looking at this latest reporting season, sort of 20% plus earnings per share growth. I mean, a lot of that is tax driven and some one-offs in there in terms of those types of things, but and the buyback sort of driving that, but it's still 20% in terms of the growth rates, whereas the Australian growth rates are well less than half that, and in many sort of sectors of the market are closer to zero. So, as an outlook, where it's very hard to use those figures and use what we've just seen here to justify a big investment in the Australian economy with the view that it's all going to turn around pretty soon.
And I guess obviously a couple of key takeouts for those listening in has been the rise of this Botox boom and government spending in general, just the infrastructure as well. Given the investment universe that we play in, and you'd naturally think, okay, well, it's going to juice healthcare potentially, it's going to juice infrastructure, but sort of something that's on our radar.
Yeah, certainly. Look, the big issue with healthcare again is worth noting within CSL, Cochlear, they're not Australian stocks; they're global stocks,
right?
And so their markets are global, and so when you look at those ones, we look at them as Australian demand's such a tiny proportion of their overall that that's not really worth we consider them in a different light. So the Australian health economy growing strongly has a very marginal effect on those. When you start digging through some of the rest of them, Sonics and Ramsay's and companies like this, some of them have issues, some of them don't. There's a number of them expanding overseas as well. I think within that sector, there's certainly some expensive companies relative to what we see overseas.
Sure.
Again, so the healthcare's, yes, there's some positives within that sector, but we're quite selective about what we're taking, just because it is a matter of weighing up the cost versus what you can get elsewhere. But healthcare is certainly one we want to buy more of. Mm-hmm. It's more just the valuations are generally the thing that's holding us back in that sector. In terms of infrastructure, yes, we've got a few infrastructure plays. The issue with infrastructure is generally that there's not a lot of companies where you can buy infrastructure in Australia without getting property development at the same time and or mining contracting.
Yep.
So yeah, it is a matter of trying to work out am I getting exposure to the part of the economy that I want to get exposure to,
and else dragging everything else in as well,
versus what else is going to drag me down.
Gotcha.
If that sort of turns around. So it's a there's not a lot of easy answers at the moment in the Australian investment environment.
Okay, very good. So ultimately, I guess looking offshore is a pretty hot bet at the moment.
Absolutely.
Yep.
Yes.
Okay, very good. Well, on that note, we will jump into some information about Nucleus Wealth and how you can get this involved in your portfolio as well.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, giving them the time to explore areas for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Okay, so coming up next week, we're having a look at the world's favourite growth stocks in FANGs and BAT, which I believe is Baidu, Tencent and Alibaba. So for those that don't know BAT, so head on over to proton.nucleuswealth.com. We'll be shooting that one as always, same BAT time, same BAT channel, Thursday the 2nd of August at 12:30 p.m. Australian Eastern Standard Time. As I mentioned, head over to that proton.nucleuswealth.com to register your interest, and that way we can keep you abreast of any information required. Also, of course, get asked for some feedback. As always, we're available on iTunes and any good, reputable Android podcast distributor. Podcast Addict is one that jumps immediately to mind. Feel free, you can just search for Nucleus Insights or Nucleus Wealth, and it'll come up with with today's one, obviously, and any of the previous ones that we've shot as well. So, on that note, thanks very much for attending. I hope you enjoyed it. I certainly got a lot out of it. As always, we'll be sending around our survey that you can help give us a little bit of feedback on how we've gone today, and also provide any topics you'd like us to research and present in the future. So on that note, thanks very much for coming along, and we'll catch you at the next one. Cheers.